And the run of show is going to be, we're going to have a fireside chat with our two guests, and then we will open up to questions. And I'm going to leave some time at the end as well. We're going to end a little bit early so that we can just mingle for a bit. Does that sound okay to everyone? Okay, great. Okay, so let me talk about our first guest. Our first guest is Laura Callanan, and she is the founding partner and also head of Upstart Co-Lab. And Upstart Co-Lab is an impact investment firm that is within Rockefeller Philanthropy Association, and she is here to tell us about her experience founding Upstart, as well as her experience running it as well. Just a few words about Laura's background. She was the deputy chairman of the National Endowment for the Arts. She also was a consultant at McKinsey for their social sector office. She was a senior advisor of the United Nations Development Program. She was an associate director at the Rockefeller Foundation. I'm not even through like 25% of what the accomplishments that she's had. So clearly, I think I can communicate that she has had a lot of depth and experience in this area. And she, I think, has a lot to share about her experiences about the context of impact investing, particularly around the creative economy as well. She's appeared in various media outlets, from the New York Times to the Financial Times to the Harvard Business Review. There's a lot of expertise that she has shared, and so we're really lucky to have her here as well. Another important thing is that I failed to mention that we actually have two Columbia alums because Laura got her master's degree from SIPA just down the road, and she also is a double alum because she graduated from Barnard College, did her undergrad at Columbia as well. And I too did my undergrad at Columbia. And so we have that in common. Anyway, please join me in welcoming Laura to talk about her. So thank you so much, Laura, for joining us. So the first question is about your story.
Yeah.
And so it's about, can you share the story behind your transition from, say, let's call it more conventional finance and consulting roles to your eventual career that led you to Upstart and our
Sure. So I majored in theater at Barnard, and I thought I was going to spend my whole life as the managing director, executive producer of nonprofit theater companies in the United States. And I did some work when my first couple jobs out of college were at Lincoln Center Theater and American Ballet Theater, and I was well on my way to be an arts leader. When it was time to go back to graduate school, I already realized that to be a great arts leader, I needed to know more about money and finance. I had worked for some really well-run arts organizations like Lincoln Center Theater. I had worked for some always teetering on the edge of insolvency arts organizations like American Ballet Theater and Circle Repertory Company, which is an off-Broadway theater that went out of business, right? So I also observed that the board members of the top arts organizations, in those days they were investment bankers. Today they would be running hedge funds. And that oftentimes the leadership of the theater could not have a really clear dialogue with their board. The board was looking at things through balance sheets, or were framing questions using financial terminology and concepts. And the arts leaders just didn't have that vocabulary, those tools, or those frameworks. And so I thought, well, if I want to be able to talk to my board members, I better know something about money and finance, because there's going to be all these financial people. So I went to SIPA, I got a master's in public administration, took half my classes here at the business school, and I wanted to learn about money and finance. I had two job offers coming out of school. One was to go to the Ford Foundation and give grants to arts organizations, which had been my dream job. The other was to go to Lehman Brothers and do public finance investment banking, working with colleges and universities and museums and other large endowed cultural institutions. So I figured I'd never get another chance to enter the private sector or Wall Street with my BA in theater from Barnard, so I jumped at it. It was a good complement to the work I had been doing out of college, which was arts fundraising. So I knew how to ask for money. I learned how to borrow money in the public markets by issuing bonds. And after about 6-8 years of this sort of work on Wall Street, I thought, well, what do you do if you run a nonprofit that actually has some money? How do you take care of that money? And I was able to parlay my basic finance skills into endowment management. First at the Wallace Foundation, which at that time was one of the largest arts funders in America and had a very, very simple investment portfolio because 75% of their assets were still in one stock. the stock of Reader's Digest magazine, which was the company that the founders of the Wallace Foundation had created. And because they didn't have any children when DeWitt and Lila Wallace passed away, all of their wealth went to create the Wallace Foundation. So it was a very simple portfolio to learn on. There were no privates because so much of the portfolio was essentially illiquid, being in a single stock. You could only have a few managers in any category. It was a very plain vanilla portfolio. So a great place to learn about asset allocation, spending rules, benchmarking, how do you interview and hire managers, all that sort of stuff. How do you work with an investment committee? It's a good place to learn. After a couple years at the Wallace Foundation, I got recruited away to the Rockefeller Foundation, which had a much more sophisticated endowment team, a very experienced chief investment officer. I was hired to work with her closely on the venture and private equity portfolio, which at that time, that portfolio was about $400 million. And so I got to apprentice. And I would say a lot around investment, I think it's an apprenticeship business. You can study hard, right? Learn all that you can while you're in school. But there definitely is a difference when you get out and you have to do an investment memo, as Aparna will talk to you about in a little bit. So I was recruited away to work at Rockefeller. I went in to manage the venture and private equity portfolio. Over the 6 years I was there, I grew in my role to be the deputy chief investment officer with overall responsibility across the portfolio. But the best part of my job was getting to co-lead the early impact investing work that the Rockefeller Foundation was doing at that time. The term impact investing did not even exist. It was double bottom line, triple bottom line investing. We had about $25 million to experiment with through an effort called the Program Venture Experiment. The thesis was the Rockefeller Foundation knew how to give money away as grants, and maybe some of those opportunities that had been receiving grants were qualified and appropriate to actually get a loan or even an equity investment. And so this was to test out whether there could be a different use of the foundation's capital in a way that you could invest it and it would actually come back, and you could recycle that capital for other things. So that's a little bit of a story of how I began the work in impact investing.
You know, one takeaway that I'm getting from how you arrived at Rockefeller is that in that role at Rockefeller, you got a great deal of autonomy in terms of determining which investments to make, how to vet particular opportunities. I'm wondering if you can talk about how the work experiences you've had apprenticing under different leaders influenced a unique approach that you developed individually in that role and also today.
So a 35-year-old at the Rockefeller Foundation has limited autonomy. Okay? You have an opportunity to engage and make a difference, but we had an investment committee. It was made up of the chief investment officer and myself coming with the financial experience. We had a colleague who also had some investment banking background who was the full-time person on this program venture experiment. And then we had leaders from each of the four grant-making areas that the foundation worked in at that time. Someone focused on health equity, food security, working communities, and creativity and coaching. So we had program expertise and financial expertise, and together the committee reviewed and decided what investments got made. Okay, so ask the question again.
So the question is how, based on the influence that you grew into, let's call it, then how did your past experience inform the unique perspective that you brought and developed?
So it was very interesting, especially in the early days of impact investing, how easily non-financial people could be persuaded that whatever the opportunity was that was coming and asking for impact investment was a great idea. And I'm thinking in particular of one opportunity where an arts leader was developing. This is when technology was new and young and fresh and very exciting, and no one really knew how it worked, right? So there was going to be software that would control the lights and the sound and the special effects and all of these things that would happen during a live stage performance. And so this arts leader, through his theater company, was saying that he was developing this software and this would be this great thing to invest in. And there were other foundations in New York who were making program-related investments into this entity. Because I had relationships in the theater community in New York City, we were able to go at Rockefeller as part of our diligence to some of the Tony Award-winning lighting designers in New York and have them evaluate the premise of this new software. We were able to go to some of the Broadway production managers in New York, the people who would hire and greenlight new tools like this, have them hear the pitch and ask questions and evaluate this offering, and they gave it a big thumbs down, right? So doing diligence, not being persuaded by the pitch, recognizing that the considerations that you make if you're making an investment can be different than the considerations that you make when you're making a grant. A grant is supporting exploration, it's supporting optimism, the way you want the world to be. It is highly experimental. An investment, it's called an investment for a reason, right? You're expecting return of and on capital alongside whatever your desired impact is. But the rules of gravity that apply in investing still pertain to impact investing.
I see. So that is a wonderful transition to the birth of Upstart Co-Lab. And so you're the head of it, you founded it. Can you tell us more about it in terms of describing the vision that you initially had, and also how that vision evolved to what you and Aparna are currently working on?
So there's a theater company in New York called Signature Theater. It's down on 42nd Street around the West Side. And the founding artistic director was a guy named Jim Houghton. I've known Signature since its start. My late husband was the founding playwright of Signature Theater Company. I knew Jim for many, many years. He passed away about 5 years ago now. And we would keep up. I was on his board for a while. We would have lunch once a year. And I was at McKinsey. I was in a deep 6-9 month long engagement with the Skoll Foundation, who you may know is a major funder of social entrepreneurship. And they give a big Skoll Social Entrepreneur Award. So I had that on my mind. We'd been spending a lot of time with the Skoll folks. And Jim was talking to me about his vision for the Signature Center, this new, at that time, this is 20 years ago, new 3-theater complex on far west 42nd Street, funded through a public-private partnership, designed by Frank Gehry, with a really significant lobby space that was going to be a community green in the middle of Hell's Kitchen, open to everyone, whether or not you had a ticket to see a show or not. He had a big vision for what this theater was going to be all about. And I knew the theater when it was on Bond Street in a 99-seat space that doubled as a sound stage, and the budget was $30,000 and they had nothing. And suddenly this was going to be this $100 million project, right? And so Jim's talking about the vision of how every ticket's going to be affordable, at that time priced at $25, and how the kind of work they were going to put on stage. And I heard the words coming out of my mouth. I said, Jim, you're what they call a social entrepreneur. But nobody calls you that because you're working in the arts. And you don't call yourself that because you're working in the arts. But take it from me, I'm a highly paid McKinsey consultant. I know this stuff, and this is what you are, you're a social entrepreneur. So, we finished lunch, I went away. Over the coming 6-12 months, I kind of scratched my head and I thought, okay, if I hadn't known this guy for so long, if he wasn't such a close family friend, would I put him in the same category as Wangari Maathai, Paul Farmer, Muhammad Yunus, Jacqueline Novogratz, whoever we think of as our card-carrying social entrepreneurs. And if Jim did meet the test, the objective test of a social entrepreneur, was he the exception that proves the rule? Was he the only artistic person in America who's really a social entrepreneur? Or were there a lot of creative people who are social entrepreneurs? And this is using that definition where you can be working through a nonprofit or a for-profit and still be thought of as a social entrepreneur, because Jim was obviously working through a nonprofit theater. Are there a lot of other creative people who are social entrepreneurs, but they don't know about the Skoll Foundation, and they're not getting these awards, and they don't have access to the skills and the networks and the capital that social entrepreneurs need to be successful? So I thought about this for a while. I dug into it. I gave a keynote at SOCAP in 2013 called The Surprise Social Entrepreneur. And the surprise was I was describing Jim Houghton in my presentation, but I camouflaged it. So you didn't know it was somebody in the arts. So you thought, like, you believed this person was a social entrepreneur, and then the reveal was, guess what? This guy runs a nonprofit theater. Does that make you rethink who's a social entrepreneur? When I got to the National Endowment for the Arts, I started to really investigate this because increasingly, creative people were not starting nonprofit organizations to scale and sustain their work. They were starting for-profit social purpose businesses. They didn't need a grant from the National Endowment for the Arts or the Ford Foundation. They needed an angel investor who understands impact. They needed an impact investment fund to take them to the next stage. They needed impact investors to help them to continue to grow, right? They needed to understand what it was to be certified as a B Corporation. They needed all those things that the other social entrepreneurs need. And so Upstart was launched with that creative person in mind, that creative person who wanted to be an entrepreneur working through a for-profit social purpose business. And we experimented with a number of different programs and interventions and solutions for these creative leaders over the time. And for 2/3 of our journey, we're now in our 9th year. For the last 6 years or so, it's been pretty clear that the impact investing tool was what was most missing and where we could have the greatest impact. We could have the biggest influence, bringing some of the multiple trillions of socially minded capital in the U.S. to the 5% of the American economy that's in creative industries like fashion and film and TV and video games and so on.
It inspired so many thoughts in my mind. I do have a question about Upstart and how you and your team evaluate investments, but I have to make a remark because like the parallels are crazy. The story you told about how artists, folks who lead theaters, require capital in order to scale their ambitions, right? That story, when I think of that, and this is going to camouflage it even more, it reminds me of the birth of the biotech industry. Because it happened in almost exactly the same way. It happened in the Bay Area, basically, in the 1970s. And what you had was a bunch of academics, chemists, biologists, who had solutions and wanted to do research, but they had to rely on grants, like from the government. And that's really slow, but their ambitions were huge. And so there's a person, I forget his name, but it was an early venture capitalist who said, well, I'll fund this, right? And I can do it with these terms that have commercialization potential. But that gave birth to an entirely new, that's the birth of the biotech industry, like right there, because of a novel financial solution. And this is very much kind of a similar way to think about this. I'm not saying that there's something like the biotech industry here, but you see these patterns emerge when you hear these different types of stories. So thank you for bringing that up. Back to Upstart. So with Upstart, I'd love to learn more about how you and your team kind of evaluate certain investment opportunities. How do you think of social impact, creative impact, but also economic returns and sustainable economic returns?
So we are launching now an inclusive creative economy strategy. We're targeting market rate returns. We're making equity investments at the venture stage. We're investing in funds that are investing in seed and early stage companies, and we're investing capital directly into seed and early stage companies ourselves. So we're taking a portfolio approach, and I can talk about why we landed on that. So the criteria, how we evaluate opportunities that come into our pipeline, as both Andrew and Aparna know well, because they've been working on this, we filter through 3 layers of analysis. The first is this in a creative industry? Is this business in a creative industry? So we're not talking about creativity as a mindset, creative accounting, creative pedagogy. We're not talking about creativity as a skill set, i.e. the graphic designer who's working at a law firm or a bank, right? Who might be doing a creative role in an organization that's not a creative organization. We're talking about creative industries. And why are we doing that? Because we're talking about placing investment capital. How do you place investment capital behind a creative mindset or behind that creative person in the non-creative business? Doesn't make sense. So we looked at how states and regions across the United States define their local creative economy for the purpose of their economic development planning and jobs growth. We looked at international definitions of the creative economy that come from UNCTAD, which is the trade agency of the United Nations, the EU, the World Bank, the IFC, all big economically oriented institutions that are thinking about the role the creative economy can play in sustainable development. And what we learned was how the creative economy of a place reflects the culture and heritage of the people in that place. The state of Michigan does not include food in its definition of the creative economy. The state of Louisiana does. You can think of the role that food plays, Creole cooking, New Orleans, beignets, chicory coffee, all that good stuff, right? So Upstarts, using a national perspective, so we looked at how states and regions across the US define their local creative economy. We included all industries that appeared in any region in a creative economy definition. We used the taxonomy of the NAICS codes, the North American Industrial Classification Standards, because our audience were investors and business leaders, so we wanted to speak in a language that they understood. An arts taxonomy was not going to be useful in the conversation we wanted to engage in with investors. And we identified 145 NAICS codes that represent the US creative economy. That is the first layer of analysis when we see an opportunity. Is it in a creative industry? The second assessment is, does it align with Upstart's impact thesis? We have 5 elements to our impact thesis. Access to capital for BIPOC and women founders, whether it's through funds or directly. Quality jobs, especially for BIPOC women and folks in low-income communities. Quality jobs in the creative industries. Vibrant communities anchored around creative places and businesses, so the role that the creative economy can play in comprehensive community development. And those are 3 impact priorities that a lot of impact investors share: financial inclusion, workforce, and community development. So we actually have 3 investors committed to Upstart's inclusive creative economy strategy who don't care about the arts, they don't fund in the arts. They're foundations who believe in our impact priorities, and they didn't want to exclude the 5% of the US GDP that's in the creative industries from the impact that they were trying to have. Then we have 2 elements to our investment thesis that are more closely aligned with our commitment to creative people. Sustainable creative lives, artists, designers, creative people, what it looks like to enable a creative middle class in the US. And what we term the inclusive creative economy. It's our own concept. It's based on 3 tenets: a belief in the power of diversity and inclusion to solve hard problems better and faster, a general orientation to openness and experimentation as the way that you discover new, better solutions, and a belief in the power of both traditional wisdom and innovation, and how those 2 things need to live side by side. So that's the second filter for us. Do we think that this fund or this company align with most of these 5 impact criteria? And then the final assessment for us is this an investable opportunity? Is it an art project? Is it a nonprofit? Then no, it's not in scope for us. But is it something that has all of the other legs that you'd look for in an investable fund or an investable company? And so then we apply the same sort of principles and considerations and diligence questions that you would expect from any investor.
So I do have there's so much I want to ask you. I do want to bring our second guest to the stage.
Please.
But let me just maybe ask one more question to you so that we can engage in a broader conversation or lead into a broader conversation, which is really about kind of like stepping out about and your beliefs and how they've evolved since you've started Upstart, about the challenges in the creative economy and investing in the economy, which is that what did you come into this role with as a founder that you believe that have since changed with your experience that you've had? So
all the optimism and expectation I had of the potential of the creative economy has been completely satisfied. Like one of the first things we needed to do, and the reason we started by building this deal pipeline, was to prove that there was an investable opportunity set. Because that's the first. People are like, well, if I give you my capital, where are you going to place it, right? Yeah. So no disappointments there. The challenges that we've experienced, I think, are not unique to Upstart or unique to the focus on the creative economy. I think the challenges that we've encountered are the same challenges that anyone in the impact investing conversation faces, when they are bringing something new into the discussion. So gender lens investing now seems like it's always been there, right? It's prominent women-led funds, gender lens investors, women angel investors. It feels like we've always had that. We didn't always have it, right? It started to percolate up in about 2011, 12, 13. It has, it's only really 10 years old. So we actually turned to the mothers of gender lens investing in the first days of Upstart and said, we want to do what you did for companies that are led by women or products and services that benefit women. We want to do that for the creative economy and tapping the capital that's held by artists and art patrons and art lovers and endowed cultural institutions in the same way you've tapped the capital that women control. What's your recipe, gender lens mothers of gender lens investing? Like, how did you do it? And they said, make the case, build the coalition, and bring investable products to market. And I share that because we have really followed that, and it has served us well. And I think that it's a good mantra for anyone who has something new, a new theme, a new demographic group, something new that they want to bring to the attention of impact investors. Make the case, do your research, build the evidence, have the examples like your biotech example. I wrote it down. You have to figure out who that person was, and we're going to start to point to that, right? Show parallels in other industries or in other parts of the impact investing history books, right? Make the case, build the coalition of people who believe what you believe, who will help you to demonstrate what's possible. We did that for 3 years with 10 families and foundations who were part of a member community who helped deploy $12 million into 14 opportunities during the heart of the COVID pandemic. So they demonstrated that it was possible to do it, and the team working with them demonstrated we were the team who could help investors put their capital into the creative economy and then bring investable products to market. We did that with CDFI partners in our first few years, working with Lisk and Calvert. So we had these AA rated counterparties issuing notes, and the capital raised through the notes helped to build affordable housing for artists and affordable shared workspace for creative economy businesses. And now we're bringing the first ever dedicated strategy at this intersection of impact investing in the creative economy in the United States. We're bringing that forward. We've raised almost $15 million for this strategy, first time fund, essentially. And we're starting to deploy that capital in the next month. So very exciting time to be talking to all of you.
Speaking of which, one person who has been incredibly involved in that needs no introduction in these halls. So I'd love to invite Aparna Bagade to join the conversation here. I have some notes on Aparna, but I'm just going to wing it. So Aparna was a student here at CBS, graduated last year in May. All you need to know about her is that she was the co-president of Follies. That's about it. That's all I got. There's a lot to know about Aparna, however, but I think it's better told through her words. I got to know her because she was a wonderful student in my class, and we continued talking after she graduated, and it's such a pleasure, let me say, to be here and to moderate a chat like this with a former student. You're not the first student that this has happened to me for, so you're special but not that special. I just want to keep that in check. Yeah, but I'm really excited for this, and so maybe Aparna, we can start by telling us and everyone here about your role at Upstart and what you've been responsible for, and the very kind of piece of news that Laura just alluded to.
Absolutely. So I started Upstart in September, so I've been there almost 6 months now, which is very exciting. And like Laura mentioned, as part of our fund, we invest in both funds and companies. So my role is on the fund side. I lead on fund manager diligence and research. So that includes everything from sourcing the funds all the way to doing the complete diligence, getting to know the fund managers, and all the way up to drafting complete diligence reports or investment memos and presenting them to our investment committee. And yesterday, very excitingly, they gave us the green light to invest in 2 of our funds. So we're very excited. We're in the process of doing that now.
And those are the first investments we've brought to the committee recommending investment, and they gave it the thumbs up. So we will be deploying capital in the very near future.
It's very exciting, but that's a little bit about what my role is.
So 100% hit rate since you've joined.
I mean, what can I say? It's, if you take tech strategy, that's what you get. It's what you learn.
Why CBS? Indeed. Indeed. Okay. Maybe we can back up a little bit and talk about how your experiences. You were a consultant before. You went to school, studied econ. You came to CBS. How did those experiences inform your transition into impact investing and working at Upstart?
Okay, so the economics definitely had no impact on anything, so we'll put that to the side. Consulting, I enjoyed it. I kind of joined it right after undergrad, so I'm not gonna make it sound like I was very intentional about the decision. In all honesty, it was kind of a good career path as a first job outside of undergrad, and I really enjoyed it. But what ended up happening, and some of you may have had similar experiences, is that when we got to the pandemic and suddenly we were working from home all the time, it kind of made me realize that maybe what I liked most about my job was going in and seeing my colleagues and working with them as opposed to the actual work I was doing. It's not that I didn't like the work, it just, I felt that maybe there might be something that I enjoyed doing even if I was at home by myself, which was the case in the pandemic. So then I started reflecting on what that could be. And one of the engagements I was involved in at Deloitte was actually working on business development. So this was not a client engagement, but working with a government agency where we were trying to use banking transactions to identify human trafficking networks. And I really enjoyed that piece of work, which made me realize actually what I might find most joy from is doing something in the social impact space. Like I think that would make me motivated to do work regardless of if I was around people or not. Like that itself would drive me through the work I was doing. And that's when I made the decision to apply to business school, because I realized actually I need to explore this space more. I don't know a lot about it. I just think that I have a feeling it would be a good fit for me. So that's when business school came into the picture. And I knew the Tamer Center was a big part of Colombia, and I thought that's why it would be a good fit for me. And here is where I kind of honed in on impact investing. I had the great opportunity of being a part of Colombia, which is the impact fund, which some of you may be a member of or a part of the leadership team. And I think that was my first foray into actually, this is what impact investing looks like. I really resonate with it. And I was, I think, part of the team for 2 years. And I think that's what kind of got me started with realizing, okay, narrowing it down from social impact to impact investing.
So I'd love to ask you about that experience. Colombia, many, I think, of you here know, but just in case you don't know, it's a student-run impact investing club, but there's also real money attached to it. It's not just like a simulated experience. And also there are benchmarks that are attached to it. I'm not familiar with exactly what those benchmarks are, but you are obligated to those. And so I'm wondering if you can talk about, as a person who's kind of entering the field, what were some of the surprises that you had, or some of the perhaps light bulb moments about what you learned from that experience? And did you take that with you to Upstart?
So my role in Colombia was around impact measurement and management. So we were starting a little bit from scratch with the development of this team and this framework, just because I think that role hadn't existed in the club before. That's not to say that the club wasn't making impact investments. It's just that they were making the investments in social enterprises, just assuming because they were social enterprises, they were going to be making some form of impact, but not having any mindful tracking of what the impact was, understanding what their investments were doing. So that was really exciting for us to be able to put together that framework. And I had a really great team. I think some of them are still second years here, so that's really fun. But what we did was we wanted to make sure that when we were measuring that impact or figuring out what that framework looked like, that we were doing it in a way that worked for the social enterprises we were going to be doing due diligence with. So we actually reached out to one of our existing portfolio companies in Colombia and worked with them to understand, okay, what are metrics that are feasible for us to collect from you? What are metrics that make sense for you as well as us? and they were specifically in healthcare. So I think through that conversation, we realized it's not going to be a one solution fits all. There are some metrics, like Laura was mentioning, that many impact investors are interested in, but there are also a lot of the industry-specific metrics that different companies will be able to access, and also will provide the investors a better understanding of the impact they're having. So we use that to, I say framework, but it was fairly flexible because we wanted to be mindful of, one, there are different kinds of metrics you can even collect, but two, these are small social enterprises. We don't want to burden them with tracking and collecting metrics that are going to be really difficult. They don't necessarily have the team to dedicate a person to just tracking that impact. So I think that was a lesson I learned as part of Colombia that I've tried to carry with me into Upstart, kind of acknowledging that actually it's not one impact metric fits all, and just also being mindful of their time.
Yeah, I love that you said that because it drives home the point of something that I see all the time. And my next question is related to this. It's basically about examples, and I'd love to hear from both of you on this based on your experience. But across many of the organizations that our students work with as part of inclusive entrepreneurship, probably the most common task that they're given, which is a huge responsibility, is measuring impact. And it's just like, well, tell us how to do it. It's like, you're from business school. It's like, tell us how to do it. And it's like, well, like, you have to have domain knowledge, as you said, because they're specific to certain industries, certain roles, perhaps as well. So could you give us some examples of not just what specific metrics you look at that might be unique to certain sectors, but also like how you came up with them? Like, is it something that you observed, had to do interviews to do? Did you have to synthesize them? I'd love to learn more about the process of how you just came up with that.
So I can touch on some of the impact metrics we've seen in our funds that as part of our due diligence process. I think a lot of the funds track basic diversity statistics in terms of the number of female members of the leadership team. And I think this actually, I'm going to take this moment to clarify that with diversity metrics, what we've found to be most important is not just the overall diversity of people within who are employed by the company, but who's actually in those, who are actually in those leadership decisions, who have the power to actually enforce change. Yeah. That's where you want to be seeing diversity. And it's interesting because there may be opportunities for companies to skew those statistics by bringing on people of diverse backgrounds in perhaps less change-affecting roles, and that's all well and good, but what you really want to see is the diversity reflected in the more leadership roles. So that being said, one of the metrics that a lot of the funds that we've looked at report are around diversity, whether that's gender, whether that's around race, as well as job creation. I think that's something we're seeing more and more, how many jobs have been created as a result of an investment in a company. In terms of sector specific, I might hand it over to Laura.
Yeah, I think your question was maybe geared to my Colombia experience. So why don't you?
Was it?
Sure. I mean, it's about how that informed these, but I'd love to also just hear about currently, at Upstart, how you're evaluating.
So if you look at our website, you'll see examples of our impact report, and you'll see that we take both a top-down and bottoms-up approach. The top-down is we assess across the portfolio whether the 5 elements of the impact thesis that Upstart holds that I just described, right? Access to capital, quality jobs, vibrant communities, sustainable creative lives, and an inclusive creative economy. How we're doing with the investments that we've supported across those 5 dimensions. We do that primary, secondary, not explicit. It's a check, tick, we don't say 92.3 or 87.1, right? It's kind of bold strokes. We define each of those terms, we talk about it as a team, but it's a tick box system. We then have a page dedicated to each individual investment, and there we reflect the impact metrics that fund or that company that they have determined are the impact goals that they are driving towards, where they've set the metrics, and as a management team, they're using those impact metrics to assess whether they are on target or not. And they're not all the same, right? Even within an industry or even within whether it's a fund versus a company, they're all going to be different because each impact thesis, each business plan for each fund or company is going to look different. And part of the reason that we do this bottoms-up approach is we don't want to burden emerging managers or early stage funds to collect information that we, the outsiders, think is interesting and informative, but maybe not useful to them. And two, impact measurement is still a very nascent space. So we need a certain level of humility in terms of what are the right metrics. And we're going to keep learning and evolving as a field, determining what the answer is to that question. And so we believe that by demonstrating how quality funds and companies are reflecting their own impact goals and measuring toward their progress towards them, that's going to be a great way for the whole field to learn.
Speaking about the evolving field, this is going to be my last question before we turn it over to all of you for Q&A. It's going to be about the future and how both of you feel about the future of investing in these areas. And specifically, just to make this a bit more of a constrained question, what areas of the creative economy have you learned about that you're most excited about looking ahead, midterm, long-term, however you want to
We have all of it.
Okay, all right, good answer, good answer.
We have done research deep dives on fashion, on food. For us, we think not about food in terms of human and planetary health and wellness. We think of it as a vehicle for tradition, heritage, community building. We have done a deep dive on film and TV and video games, and we've done a deep dive on the creator economy. Not the people doing pranks and jokes and trying to sell you beauty products, but the people who are making content and telling stories and bringing their creativity online. Yeah, so we've done deep dives into all of those categories.
Wonderful, wonderful. There's so much more for us to discuss, but I cannot take up all the airtime. And so let me toss it to anyone here. Feel free to raise your hands, and then we can have a conversation. Anything that's interesting for anyone? Thanks. Please.
Hi, my name is Roy Swisson, J7 here in Colombia. I'm curious to hear how is the structure work? How do you gather LPs? How do you maintain relationship with your LPs? And is it like on a yearly basis? Are they have like a lock-in period? Because there's time until some of this process here. So can you elaborate a little bit about that?
Sure. So what I heard, I'm just going to repeat it because we're taping, right?
Please.
What I heard for the question is, how does Upstart work with our investors? Who are they? What have they signed up for? What are their expectations? Kind of some of the mechanics around that. So Upstart's Inclusive Creative Economy strategy is the first of its kind in the United States. There is a tradition, there's a track record within impact investing that the first time you do something, you turn to philanthropy to support the entity that's building the field, building that space in the impact investing ecosystem. That's why we at Upstart Co-Lab, we're a nonprofit, right? So philanthropy allows us to experiment and build this space. And that the investment capital that you use is also philanthropic capital because there's a high level of risk associated with this. And philanthropic capital is the R&D capital for social change. So this is a good place to put it to work. If you remember what I was describing early in my career, the Rockefeller Foundation incubated a project. They used money that they otherwise would have spent in grants to test and see whether this impact investing thing could work, right? So the investors who Upstart has targeted to put capital into our strategy are foundations. They're individuals and families with donor-advised funds, which is a philanthropic giving vehicle that is more nimble and smaller than a foundation. And we have one museum, an endowed cultural institution, so a nonprofit that has its own capital to invest. So part of it is we thought that those would be the types of investors most interested in what we're doing. There are some technical reasons as well. We're a nonprofit, and we have an implementation partner that's helping us custody and deploy, and manage the transactions around this strategy. This is Impact Assets. They're a $3 billion donor advised fund platform that was set up about 12 years ago to demonstrate that donors could make impact investments out of their donor advised funds before the money goes out as philanthropic grants. So Impact Assets is also a nonprofit. There's an exception to the registered investment advisor rule that allows nonprofits to advise other nonprofits on investment matters, but not for-profits or private private investors.
Oh.
So we could not accept Dan's capital out of his personal checking account, no matter how much he wants to give it to us for the purpose of this strategy,
So much.
because
Yeah.
you're a private investor, Dan, so we're sorry about that. So we are working with a set of investors who understand the exploratory nature of what we're doing, that it's never been done before. They want to be pioneers and help us prove the potential of the impact of impact investing in the creative economy. They understand we're investing in funds and young companies and that their capital is going to be locked up for 8 to 12 years. And everyone's doing this in the spirit of exploration and discovery and doing something first. Now, our hope is that Upstart does this. We de-risk and decipher the creative economy for the impact investing field, and that other impact investors who are taller, smarter, better looking than those of us at Upstart, who have deeper pockets, can come on in and bring their resources and their expertise to invest in the creative economy. We're not trying to own this space as Upstart, but if we don't go first and take these risks and demonstrate what's possible, I don't think other impact investors, no one else has been doing it before us. So if we're not here to make this space more visible and accessible, I think impact investing will continue to grow, but the creative economy will continue to miss out. So we're trying to plug that gap by demonstrating the potential and then hoping others will swarm in and make it even bigger.
Yeah, I thought that was a great question because I learned so much from your answer. But it also, I like a follow-up, which is that because you clarified that it's at this stage where this is the kind of organizational form that allows you to achieve your purposes of building a coalition, let's call it, most effectively. Do you envision changing the form of your organization at later stages, perhaps to not be a nonprofit? I know you're under RPA right now, but like...
Not now.
Okay.
I mean, I feel like there's a role for us to play, and as a nonprofit, we can be seen as a trusted partner in a way that we would not be seen if we were a for-profit. It also gives us both the capacity and the obligation to be radically generous, sharing what we learn with the field. So while we consider our deal pipeline to be proprietary, we have, if you looked at our website and you read all of our research reports, you would see a lot of what's in our deal pipeline, right? We're not going to hand it to you, but it's all, we use it as a way to give case examples, and it underpins all of our conclusions and our points of view. So again, working with foundations and donor-advised funds and endowed public charities as our investors, they also understand that alongside our investment strategy, we essentially are running an influence strategy, that we will be radically generous sharing what we learn along the way, that we are investing in funds to be able to bring those funds that have strong exposure to the creative industries to the attention of wealth advisors who have impact investing clients who've been asking them for opportunities to invest in alignment with their passion around arts and culture. And the wealth advisors are like, there's nothing, we can't help you. Why don't you put more money into like the environment, right? We're investing directly into companies because we know that fund managers need to feel comfortable engaging the creative industries more deeply than they do now in the impact investing space. And also, if we want to lift up the creative economy and the impact investing conversation, a fund manager can be great and compelling, but investing in a fund is kind of wonky. But that entrepreneur with their story and their smiling face and their great vision is going to be very inspirational. And we want some of those stories to support the messaging around the potential that the creative economy offers for impact investing and for social change.
That's very great. Other questions? Oh, there's so many. I'm going to let you choose because, I've...
Sir in the blue, black sweater, yes.
Me, okay. So thank you for being here. My question is in terms of the type of, from an investor perspective, are you going to the market currently saying that these are concessionary opportunities, or are you using a catalytic capital approach to kind of reduce the risk that's associated with some of the investments that you make so that you can say, hey, look, yeah, this is great social work that we're doing, but also you're getting returns that are close to or beating the market?
So we are targeting market rate returns. We're making equity investments in emerging funds and seed and early stage companies, and we're we modeled out what our returns might be. Worst case, 11%, best case, 20%. A model's just a model, right? You don't hang your hat on it, but we wanted to get a range, a sense of what the returns could be. However, to your point, there is a lot of risk in this having not been done before. And so that is why most of the foundations, not all of the foundations, but most of the foundations who've committed to our strategy are using the program-related investment tool, which is a creature of the IRS tax code, which indicates that the foundation is making this investment first and foremost in alignment with its charitable purpose, and secondarily for financial return, right? And so we've had dialogues with some of the foundations because not every people casually associate a program-related investment with a concessionary return. And there are cases where that happens. But there's nothing about the rules surrounding a program-related investment that requires the returns to be concessionary. It just requires that social impact be the primary reason that the investment's being made. And so we've pointed out that while we're targeting market rate returns, because we're doing it in a space that's never been explored before, who is it really to say what is market rate, right? Because this is uncharted territory. So you could call it catalytic capital if you wanted to, but because that does connote subscale returns, that's not language that we use. Yeah. In the back row in the white sweater.
Thank you. I have actually two questions. One is, I know a lot of the creative companies, they're very small and they scatter around all places. How did you guys go and find them? And then the second is for the exit strategy, is like investing in creative economy. It's like usually like VC, like all the exit strategies the same, like you hope it will get acquired by some other people or IPO, but I don't know. I feel like it's like very different for all the creative companies. It's hard for them to go to that stage.
I think this is a great opportunity for you to talk about the consumer goods space and some of what we've been looking at recently.
That sounds good.
The exit piece.
And so yeah, I'll touch on the exits. And so some of the funds we've been speaking to are focused on consumer goods. So think like beauty companies or hair care. And I agree, there are a lot of companies in this space that are smaller, but I think there are so many big brands that are actually in this space, and they start off small. They start off getting like venture capital funding. I think to name an example of a company in the public domain that has exited and grown really rapidly, but started off small. You guys might have seen like Instagram ads for like Function of Beauty, which you can like, I'm seeing nods, great. So it started out so small. It started out only online, and a lot of us have probably seen it and ordered from it. I have not, but I should try it. But they're huge now, and it's because they got venture capital funding. So it can be surprising how many can reach that big scale. But I do agree, a lot of cases it is acquisitions. We've seen a lot of funds where the exits we're starting to see have been through acquisitions.
And in fact, that is part of the investment thesis of one of the consumer goods funds that we recently completed diligence on. Their thesis is consumer goods is going to grow differently, require less capital than typical VC investing in tech. But the advantage is there are multiple exit opportunities because the legacy brands will acquire the new hip, wonderful product because it's harder for the legacy brands to innovate internally. Your first question was, how do we identify the direct company opportunities that we work with? So a few different ways. We are in the press a lot. We're at conferences a lot. We have a lot of inbound inquiries. There's a banner at the top of the homepage of our website that says, are you raising capital in the creative economy? Click here. And so people can come in and look handsome and send information to us, and we look at it and we talk to them. We have a stellar advisory board and investment committee of impact investing leaders. So anyone, anywhere who talks to them about anything related to the creative industries, they send it to us. And they're pretty savvy and a great first screen. We have a network of what we call our feeders. These are other fund managers, incubators, accelerators, folks in the impact space, folks in the creative economy space, and we put out an open call periodically to remind everybody that we're out there and to send great opportunities our way. We As Andrea can attest, we look at Crunchbase and a number of other data sources and stay on the lookout for opportunities that fit our thesis. So there are 4 or 5 different ways that we identify opportunities.
Other questions? There's some from this side.
Jumping off that, then how do you evaluate different opportunities? You mentioned the difference between creativity between Michigan or Louisiana. But if I'm a company that wants to start a Creole food company, and then there's also somebody that wants to do cheese manufacturing in Wisconsin, how are you weighing those options, and are you looking for immediate impact first, or how are you creating that pipeline?
Yeah, so once we know you're in the creative industry and you tick the first box, right, you pass the first filter, then we look to see how strong your impact thesis is and how well aligned it is with our impact priorities. So maybe the cheese maker's not as strong, or maybe the cheese maker's stronger than the Creole food company. And then the third piece is investability. Which company has the right leadership team? Which company already has revenue? Which company, has the best understanding of its customer base and repeat customers? Which company has already successfully done their seed round, or they're on a safe and they've lined up a lead investor for their series? Then there are a lot of business considerations that come in.
They make more than just cheese in Wisconsin. Invest in breweries too.
And maybe building a bit on the answer you just gave, so you said the second step you're looking into how much impact they make. Does that mean that impact is like the first criteria, the higher criteria versus the returns that you'll get? Because the returns are only in the third stage, or how do you balance those two?
We end up weighing impact and returns when we make the actual investment decision. This is just what qualifies an opportunity for us to do deeper diligence on it.
It's like the first filter, but you would still take into consideration everything before making the investment.
And how do you then weight it? Because I think impact is sometimes harder to measure, and especially if it's a longer term. How do you weigh the difference between returns in capital and the impact that a company would make?
So with the 2 funds that we brought for investment committee decision yesterday, one fund, they're similar in that they're both women-led funds and they're both essentially in the consumer goods space. The first fund has a team with more experience, longer, stronger track record, experience as company operators. They talking about better for you, better for the planet type products. They have not published an impact report before. They are not as well aligned with our impact thesis, but there's some alignment. They don't call themselves an impact investment fund, but they have a lot of expertise and capacity. They're well known in the consumer goods space. So in the words of one of the folks who's looked at them with us as part of our diligence, they're going to make us money, right? They have the experience and the credentials and the track record that they're going to make us money. The second fund we looked at, they are an impact fund. They do publish an impact report. They are very explicit that impact is deeply part of their investment thesis. They are very intuitive and emotional and committed to their founders. There's a lot to like about them. The 2 GPs are 32, 33 years old. They don't have that much experience. They've never been owners and operators and founders of companies. They have only lived through a market cycle of low interest rates and abundant capital, and right, they haven't been through 2008 as investors. So when we looked at these 2 opportunities side by side, the first fund looked like it was sort of better from a financial return perspective. Second one was clearly in our sweet spot on the impact side. So we will be making investments in both of these funds, but it's all relative, and you need to ensure that you believe that there is sufficient capacity to generate your target returns and sufficient capacity to to achieve your target impact. And there's an art as well as a science to making investment decisions, and that's what it looks like.
Other questions?
I just had one about when you invest into a company, what's your typical check size?
So we want our checks to be meaningful in size to the companies because we know that the companies we're going to be targeting, primarily led by women and BIPOC founders, have a very elongated cap raise process, too many people on their cap table. It's a big distraction. So we're looking to do $500,000 to $750,000 check sizes.
Sounds like that relationship with the impact committee or the investment committee might be kind of interesting because on the one hand you want them to be aligned with your culture and the impact side, but then they also need to be responsible for making sure that you're achieving your returns. I'm curious to hear just more about that relationship. How do you manage it, and how do you sort of choose the right people to attain that balance?
So I chose the people, so I'll answer that question. And then Aparna's been in quite a few meetings now, so you can make some observations about the dynamic and the personalities. Okay. So there are 5 of us on the investment committee, including me, or six including me. 3 of them have been with us really since the beginning of Upstart. One, Clara Miller, the President Emerita of the Heron Foundation, the first foundation to bring 100% of its endowment in alignment with its mission. She gave us a roof over our heads for the first few years of Upstart and was one of our early funders and has been a great coach and support to me personally. So she gets it. She was a visual art major in college. She's a big community development and impact investing leader, so she's a representation of what we're trying to do, bringing these 2 things together. Patricia Ferrar-Rivas, the retired founding CEO of Veris Wealth Partners, a 25-year-old boutique wealth advisory firm entirely focused on impact investing. She is one of the mothers of Gender Lens Investing, who we went to early in our life cycle to say, how did you do it? What can we learn from you? Give us your advice. So she not only has a lot of familiarity with the types of funds that we're looking at, but she knows what it's like to build a new theme in the impact investing space. Jack Meyercord, founder and CEO of Conscious Endeavors, represents his sister Lori, who's an artist and 100% impact investor. They have invested with us and worked with us since day one. And they've invested in every vehicle, every iteration of our life cycle. They've been a philanthropic supporter of ours and have put their investment capital to work. So they each bring different perspectives. Clara at the portfolio level, Patricia at the fund manager selection and portfolio level. Jack, before he came over from the dark side, was a private equity investor, so can really get under the hood of a company and is doing that, day in and day out for his own office. So those were 3 people who had known us for a really long time. So we knew the different points of view they brought and that they were really supportive of what we were trying to do at Upstart. But we also needed some different